We're going to talk about overtrading. If you ever had a problem, as you can see here, as our student had, that you find an area that you have 1, 2, 3 losing trade at once, then this is the video what will help you keep up from losing trades to winning trades. So here you can see how this student was doing one trade and the market was just shooting up, adjusted $100 for this trade. This is a $500, $600 trade. And then here the market was going down, adjusted $100. That's like a $700, $800 trade just here within a couple of minutes using this 1 minute strategy. So first of all, it is about to understand what is a setup. A setup is a pattern that you see on the market that is allowing you to enter the trade, but that does not mean that you have to enter the trade. A lot of students, a lot of people that are reaching out to learn trading, they assume always if there's this line or that is crossing with another line or there's this green candle, you have to enter the trade. But this is not how trading works. It is important that you understand in what direction the market is going at, that you see with experience that it does make sense, and then the strategy is giving you a system to enter the trade, to have good money advantage, and of course also a risk management. It means that you clearly can say that you only maybe want to lose like 2 trades in a row and then you stop. And what is very important, that you also enter clearly once a candle is closed, such as the color switch of a red and a green candle. I'm going to show you this one here. If we have a buying example here, if you buy here because this is the red and the green candle and you place your stop placement under the wick, there's just one color switch, stop out. This would be minus $100. Next color switch, as you can see here, entering the trade, stop loss. And then you see how the trade goes up and then 15 minutes, 20 minutes passes and here's then the next stop out. And then you would know that the market was not able to make the move from money management perspective. We had 2 tries to adjust $100 to make $500 opportunity, to get $500 opportunities. That's like losing maximum of $200, but being able to make $1,000 or sometimes even more if the 2 trades does work out. So here's the thing. So what you see here is about the trading setup that you say clearly. If you have a green and a red candle, such as here, you can see how the trader entered the trade and the stop loss was not up here on the highest point of the color switch. It was placed down here. The problem with this is that the chance to be stopped out is very high. And if you place it up here, the chance is not that high because this is like the market is built like this, that it either likes to go towards highs within a domino effect or likes to touch lows. So in one side, we want to place the stop loss, and on the other side, we want to put our take profit. That means we want to trade towards lows. If we can see how the market does lower lows, and on highs, we want to place our stop placement. In this case, you can see how the market does here higher lows, goes higher, and then on the highs, he would like to aim towards that, trading towards those area, right? So the problem with this selling here, by the way, is that when you see that the market was going up, but does an average like this length in retracement multiple times, the problem with this is if you see like here, the second retracement here, that the market did this, we cannot expect that the market continues to go here down. We more have to expect that the market continues to go higher because this is a usual retracement, as you can see here in length. And because there were a lot of green candles, it's going to be lesser than usual. And then once we see here higher structure, that means red, green, higher red, green. This is where we see then, oh yeah, there's this 1 to 5 here. There's this 1 to 5 here, for example. It's just very important that you understand where do you see that you can put $100 in and get $500 in opportunity out, right? So on the next day, you can see here, this looks a bit more nicer, and you'll see that how the market is more wider here. You can see how the market is here. So the difference is the market runs here for 30 minutes up and the trader tries to sell here, or was actually misclicking here. But what is just going to be important is to have 2 trades properly with the stop placement, with the entry, and then this trade would have even worked too. So that means with that saying, check this out. When just understanding here to enter here the trade with the stop placement on this green candle, you can 60 pixel. And it should be 300 pixel here. So until here it would be 1 to 5. And until here, it would be like 3.5 or something. That means like when adjusting $100, that would be like $350 until here. Just that you have the understanding, the market is not touching the blue line. And then the trader could still exit without losing any money. Just seeing that the market is not reaching that. And that's your long red candles. So here you see how the market is going up. The trader is not doing a proper second entry. This is the main reason why it did not work. And then the selling trade here was bad because it was an average retracement. Like it's totally normal. Like it does not make any sense that the market can even return by having this upwards pressure. Here you see how the student was trading. This was, here we have, it would be two $500 trades by using $100 a single trade. Where the violet line is, the trader was starting his trading. And then you can see here how the market did an average this retracement in length. So those are very normal. And then the market was continuing here to push up by seeing red, green. Red, green goes higher. Red, green goes higher. Here, red, green goes higher, one time lower. But the majority of red, greens, the swing. So you can see how the market has higher lows. And this shows us that the market likes to go higher. By the way, if you want to learn this, just reach out. You can find the link under this video. Just sign up there. And what we do personal trading. That means like you will sit down with me together, you get exercises, and we look forward that it works out with the trading. Anyways, the strategy is free. Just look out, just continue watching then the videos that we have on this channel. And we hope that it will improve your trading. So you see how the market has here higher structure. And it's just very important not to trade against that. You will see also, you're seeing also here how the market does more length up than length down. It does more length up than length down. So this is what shows us that the market is in a trend. And when adjusting here $100, that's a $500 trade opportunity towards targets towards the left. So those lines are just highs, by the way. It's nothing complicated. It just looks like this, that the market has highs here. That's how the market looks like on the left side. And then when you know like there are like two highs that are nearby, very often the market is pushing that out. Now there's this bigger distance, so the market has to retrace and then pushes, bam, like that. What makes it very nice to trade. Also for the opposite side direction, if you see, and this is what I meant, if you see that the market did this kind of retracement in length, here you see how the market did around the same retracement in length. So don't assume, it doesn't matter how much time the market takes, if it takes 30 minutes, 60 minutes or whatsoever. If the market does only this length back, don't assume that the market goes down. Very important. Let the market push out. It's important that you understand what actually makes the market move. And when you have here, there was a bigger structure high that looks like this. And then the low is here. And the one-day VWAP is here, right? So here you have, by the way, multiple lows, just smaller targets in between. Like if the market cannot go above a bigger structure high, it will usually consolidate to stay there. But if it means to go down, then just like down here, down here, down here, just where red, green is. And if it can push further enough, then it's the yellow line. What is the one-day VWAP? We have videos on this channel about the VWAP. Just check them out. It's the volume weighted average price. That's the average price of the market. It means the market likes to go towards highs multiple times using a domino kind of effect or like lows, and then goes back to the one-day VWAP. So when you see that the market reaches the high, draw in a consolidation phase. The consolidation phase is very important to draw in. Why it's very important to draw in? Every time you see that the market is touching this consolidation phase, as you can see here, this is very dangerous. So we can still assume that the market still likes to stay in this area. The consolidation phase shifted from here to here, as you see here. And then it stood here inside. So we would like to see that the market goes up and does not touch this consolidation phase anymore. Or in this case, as you can see here, goes down, does not touch this consolidation phase anymore. And those are the one of the main reasons why the trader took this trade. Adjusted $100, this would be a $700, $800, $900 trade maybe even. And then aiming towards those lows. Important is not to aim for this bigger structure low down here. Why? Because the pressure up is so strong that the market might turn around in any of those nearby those blue lines. That means like actually this low here, this low here, this low here. You can see here the lows, what the trader was drawing in. And then around here, the market would turn around. So just checking how the market is moving there. You will get better by just looking how the market is reacting there. What is just important for you to understand as a beginner is that you have to have a specific system on how do you look at the market that you gain experience. What references do you draw in? Like if you don't draw in this consolidation phase like this, or like this consolidation phase here, either one of these, it doesn't matter if it's this one, if it's that, you just see like that the market is sort of touching, like consolidation phase 1 is being touched by consolidation phase 2. Consolidation phase 2 is being touched by consolidation phase number 3. So, you know, it's not good to trade up here with where 1, 2, 3 is. And then down here, you see how the market breaks away. That's green, red. It does a lower high that is not touching this consolidation. Very nice. And very often you will see, because it started already to do more length down than it did even up in average, you will find very good trades like towards like the next low, or like here. Just here, $100 adjusted is like $300 towards the first target. This is what makes it already very good. And having so many red candles, usually when the market is trending, often it just does one time like 4 green candles like you see here. But majority is like multiple times 4 red candles like here and here, what is equalizing it. Like there was up pressure here. Now the down pressure was good, so it was sort of flat. And then again, down pressure, now the pressure is there, not touching the consolidation phase. Now you have a lower high, green, red, what makes it very nice. And then you can see how the student was trading this one towards this target. Use this for your trading, a clear setup. You have on TradingView on the right side a timer that counts down within 60 seconds in this case. And then 5 seconds before the candle is closing, or 2 seconds, you want to look how the candle is closing, that you can enter the trade and solidify for yourself that this candle is most likely going to stay green. You will fail multiple times in the beginning, and for this reason, use please a demo account. It's absolutely for free using TradingView, and just try to improve by understanding, if you sit down for an hour or two, how many times can you see to it that you can adjust $100 to get $500 on average out? And what is also very important, that you understand what market to trade. If you trade gold, if you trade silver, we're talking about $4 billion a day that is going in and out. But a euro US dollar has around like $27 billion every day going in and out, just the futures. In general, I think it's like 100 billion. And the S&P 500 has, with leverage, up to $300 to $400 billion every day. That means if you sit down for an hour and you can see 5 times where you can put in $100 to get $500 out, or like in this case, this trader here also 1, 2, 3, 4, 5 times, you will be trading way more better than if you have a market or a trading strategy where you sit down for 5 hours and you can maybe just see 1 time or 2 times to adjust $100 and maybe just get $50 out, or $150 on average out. And the second thing is also, you have to look at the strike rate. A beginner, it's very hard for beginners that they can win multiple times in a row with that money advantage. If they can win in a row, maybe they're losing $100 and they make like 150 times, 2 times, 3 times in a row. But important from my opinion is, especially as a beginner, to being able to lose maybe $10 and make $50 on average. And if you just have 2 or 3 winning trades out of 10 pieces in average, it is already profitable. It is already scalable, what is very important. So that means like you are not burning your account, because you can clearly say with money management, 10 trades always for a cycle. And every time you did 10 trades and there's money coming out, it is even possible to go always within a higher position size. So now, instead of losing $10 a trade, $50 a trade, $100 a trade, $300 a trade as an example. What is just very important is to use a demo account in the beginning to test that out, and always have a routine. That means like, how do you see in what direction the market is going at? How do you see your setups based on your trading strategy? What is actually your strategy, your system? You would like really to write down, if you sit down here for 1 or 2 hours at this day and time and this trading signal, how many times were you able to see it within that time on your trading time, not 24 hours backtesting, really forward, like that you are on the computer for 1 or 2 hours, how many times were you able to do a trade? And then from quantity, you can go to quality. And this is then where the trade decisioning is happening. That means if you have 30 or 40 trading opportunities, you can find those 5 good trades, 10 or 20 good trades out of that number. And then you can improve by just taking trades and just looking at the differences.